Did you know that private credit investing has exploded from $1 trillion in 2020 to a staggering $1.5 trillion in 2024? And it's only set to keep growing. But hold on. What hidden costs might be lurking in this booming market? Stay with us, because we're about to dive deep into how these rising investments could affect your wealth and what you need to know to protect it. Before we go further, don't forget to hit that like button, subscribe to the channel, and leave your thoughts in the comments below. Now let's jump in. The private credit market has seen massive growth in recent years, ballooning from $1 trillion just 3 years ago to an estimated $1.5 trillion by the start of 2024. According to Pre-Chain, a leading alternative data provider, this expansion is projected to continue, reaching a mind-blowing $2.6 trillion by 2029. But while the market is thriving, it's not without its complexities, especially for high-net-worth investors trying to navigate the tricky tax landscape surrounding private credit investments. Historically, private credit has been an alternative to traditional lending, offering funding to businesses that might not qualify for regular loans. But here's where things get tricky. The returns from private credit lending are taxed as ordinary income, meaning they're subject to the highest federal tax rate of 40.8%. Compare that to the much more favorable long-term capital gains tax rate of just 23.8%. This gap could lead to some massive tax burdens. Take a hypothetical $5 million investment in private credit, which could face a jaw-dropping $4.3 million in tax drag over 10 years, or a whopping $61 million over 30 years. That's according to Bernstein Private Wealth Management. This situation mirrors the broader picture of wealth accumulation in America, where the elite can often find ways to shield their assets from taxes, while the rest of us feel the weight of fiscal policies. As Yasho Lahiri, a funds lawyer, puts it, you're getting taxed on the insurance product, rather than being taxed on the underlying private credit investment. That's a pretty stark reminder of how wealthy investors use sophisticated financial instruments to minimize their tax bills, leaving the average investor without such tools. But it's not all smooth sailing for the rich either. Take insurance-dedicated funds, IDFs, which have the potential to offer tax benefits but come with their own set of challenges. For one, they require diversification to meet IRS standards, which can water down returns. Robert Dietz, National Director of Tax at Bernstein, explains that while these funds offer some perks, like better liquidity compared to typical private credit funds, the trade-off might not always favor the investor SO, who really benefits from this rapidly growing market and tax-efficient strategies. It's a valid question. The Senate Committee on Finance has already described the PPLI industry as at least a $40 billion tax shelter, used exclusively by only a few thousand wealthy Americans. Despite this, the likelihood of meaningful legislation to curb these tax advantages seems slim, especially with a Republican-controlled Congress. Looking to the future, this trend has major implications. As family offices and ultra-high net worth clients increasingly seek ways to maximize after-tax returns, the conversation around private credit and tax-efficient strategies will only get more intense. The low-hanging fruit of traditional investment strategies has already been picked, and now the ultra-wealthy are exploring more complex avenues. But here's the big question. As this landscape evolves, will it adapt to promote equity, or will it continue to favor the already privileged? In my view, the rapid rise of private credit and the tax strategies used by the wealthy highlight a troubling reality. It's striking that while private credit investments have soared, the tax burdens are falling disproportionately on those who aren't part of the elite. The use of insurance products to dodge ordinary income taxes shows how the system is tilted in favor of the wealthy, leaving marginalized groups to shoulder the financial burden. As these power imbalances persist, we have to ask ourselves, how long will we let a few thrive at the expense of the many?